material, work in progress, and finished goods are given, then we consider it as a closing stock. Then debtors. So debtors means good debts you have to take. So then here, if bad debts and provision for bad debts are given, then it should be subtracted. In some problem that will be given, and again against the debtors they will mention it as a good. So this is good debt, no need to subtract again. If that good is not given, then you have to subtract the provision. Then bills receivable, short-term investments. So investment in shares and securities, and expenses paid in advance, prepaid expenses. Then income to be received, earned but not received, accrued income, advance tax, and short-term loans and advances, if any, we had given, are some examples for current assets. So in the balance sheet, asset side, if we found all these things, then that should be considered for current asset. By adding all those, we will arrive current assets. Then current liability. Current liability. Current liabilities are creditors, bills payable, expenses to be paid, outstanding expenses, and short-term loans. So like bank overdraft, cash credit, and any short-term loan less than 1 year. Then expenses to be paid, accrued or outstanding expenses. We may call it as accrued expenses or outstanding expenses. Provision for taxation. And dividend. Dividend means the profit distributed among the shareholders is called dividend. So we made a provision for dividend. So from profit we kept aside for distribution of dividend, that provision for dividend. And if any dividend is not claimed, we had given that one, but they have not encashed that one from the bank. So that will be remain in our bank account. So that is also temporary fund for us. Unclaimed dividend. And income received in advance. Income received in advance. Short-term borrowings means short-term is 1 year. And loan and advances taken from the bank and other lenders, if any, are comes under current liability. So one should remember these things. So normally repeated question, that current ratio. So current assets divided by current liability is current ratio. If the ratio is 2:1, that is idle ratio. So if it is greater than 2:1, so more assets and less liability, then that is more healthier. If it is less, then it is not so good. Yes, it is clear, hope. We had seen 2 examples yesterday, I think. Yes, 2 or 3 examples. This one, third example. Wait. How many of you in the class? 17. Okay. Shall we start the problem? Hmm? Yes, are you with me? Shall we start? From the following information, calculate current ratios. Inventories, current asset. Sundry debtors, see good, here it is given. And here the provision for bad debts is given. We should not subtract. If this good is not there, then you have to subtract. Cash, current asset. Bank balance, current asset. Bills receivable, current asset. Sundry creditors, current liability. Bills payable, current liability. Commission receivable, income to be received. Income to be received, sorry, asset, current asset. Unexpired expenses, expenses to be paid, liability. Debentures is long term, provision for taxation, liability. Provision for taxation, liability. See here, inventories, debtors, cash, bank, bills receivable, commission receivable. 1 minute. Commission receivable and unexpired expenses. All these are assets. See in the question also, all assets are given one side, all liabilities are given another side. It's very easy to find out. If it is mixed, jumbled, then you have to think somewhat. So creditors liability, bills payable liability, current liability, provision for taxation liability. So 4,50,000 by 225, ratio is 2 is to 1. It's an ideal ratio. Firm is in good condition. So the liquidity position of the firm is satisfactory. Hmm. So this one actually we are seeing, nah? This one is over now. So now the next one, quick ratio. Quick ratio means just a slight change in assets. The liability will be the same, current liability, but the assets we are taking quick asset. What is quick asset? Quick asset means current assets minus stock and prepaid expenses. So indirectly one can find out quick. See if the see in the question the current ratio will be given and current ratio will be given and current liability will be given, then stock and prepaid expenses will be given. Then you have to find out quick ratio. So by cross multiplication, ratio and current liability, you will get current assets. From that current assets, if you subtract stock and prepaid expenses, then you will get quick asset. What is the sense of quick asset? Which are easily convertible into cash. So debtors, bills receivable, short-term investments, cash, bank balance, all these are easily convertible into cash. But where in case of stock, so we are not in a position to sell all the stock overnight. And expenses paid in advance at any cost, we are not able to realize them. So the unsold stock and prepaid expenses are not easily convertible into cash. So which are able to convertible into cash easily, quickly. So those assets only we will consider. So that is quick assets. Quick assets by quick liability. Current liability is yes. Yes. So when quick current what stock and prepaid expenses are given, then just you have to subtract from the current assets, or we have to eliminate from the current assets stock and prepaid expenses. So all the remaining will be current quick assets. All the remaining will be quick assets. And here is two scenarios when bank overdraft and cash credits are given. When bank overdraft and cash credits are not given. So first, when bank overdraft and cash credits are not given, when there is no bank overdraft and cash credit. So this is a liability, current liability. Quick assets refer to those current assets which can be convertible into cash quickly, in which a very short period. So that should be done in short period without much loss. Yes, that is also more important. So without much loss. In case of stock, it is not easy. So that's why they clearing the stock, sells, uh, buy one get one free, like that they will offer. So there is not little loss. There may be anticipated more loss when clearance of stock. They include all current assets except stock, means inventories and prepaid expenses. Thus, quick assets comprises of current investment, debtors, if any provision you have to subtract, bills receivable, cash, bank, marketable securities, so short-term investments, terms loans and advances, if any, given. So indirectly one can arrive current assets minus stock and prepaid expenses. Stock and prepaid expenses. Stock and prepaid expenses. When there is a bank overdraft and cash credits are given, then you have to take quick assets and quick liabilities. Quick assets, same cash, bank, debtors, less provision, bills receivable, marketable securities, short-term investment, short-term loans and advances. Are quick assets, as we had seen, current assets minus inventory and prepaid, minus inventory and prepaid expenses. In case it may be noted that there are some writers who consider quick liability as synonyms of the current liability. So some authors considered it as a same as current liability. However, evaluation quick ratio is calculated by dividing the quick assets by current liability. So it is normally considered the current liability is quick liability. There is no change in quick liability. Then ideal ratio is 1:1, where in case of current ratio, the ideal ratio is 2:1, where in case of quick ratio, ideal ratio is 1:1. So the thing is, in current assets, just we will remove stock and prepaid expenses, if any. So we'll see the problem. So in this, so they ask you to find out quick ratio and current ratio both. So creditors, current liability, bills payable, current liability, debtors, quick asset, inventories will not consider. Then cash and cash equivalent only will consider. And expenses and advance in paid in advances. So prepaid you will not consider. So quick assets, debtors, cash and cash equivalents. Then liabilities, creditors and bills payable. So the ratio is 4,20,000 by 4,20,000. It's an ideal ratio. So the firm's liquidity position is good. Liquidity position is good. Then next one, calculate liquidity ratio from the following information. Calculate not this page. Yes, calculate liquidity ratio, not liquidity. Calculate liquidity ratio from the following information. So cash and cash equivalents, trade receivables, debtors and trade receivables are same. Then investment in trade shares, tradable shares. So all these are current assets, current quick assets, quick assets. Then trade payables, current liability or quick liability, accrued expenses, current liability, and dividend declared but not paid. So it's current liability or quick liability. So cash and cash equivalents, trade receivables, investment. The sum of that is 5 lakhs. Then trade payable, accrued expenses, dividend declared but not paid. So it comes to 4,50,000. So 5 lakh divided by 4,50,000. So it is more healthier. 1.11 is to 1. So the liquidity position of the firm is strong. So this is liquid ratio. So if you know current ratio, the liquid ratio is very simple. Very simple. Hope these two things are clear. Any doubt? Yes? Is it clear? Any doubt? Hmm? Are you able to hear? Hello?
Yes, sir.
No response then. Sai, you only. All are with me or just you are doing your own work? Just log in.
No, sir, we are with you.
Huh? Hope so. Hmm? Okay, then solvency ratio. Solvency, as I already said, that the financially sound. When the assets are more, then the liabilities are less. To meet the liabilities of the firm, sufficient funds if the organization is having, then that situation is called solvent. If the funds are not sufficient for meeting the liabilities are more and the funds are less, then that is called insolvency. His assets are not sufficient to meet their obligations, then we call it as insolvency, insolvent. So then in that we will see the ratios regarding that solvency: debt equity ratio, total assets to debt ratio, proprietary ratio. Three tests we will do here to assess the solvency position of the organization. One is debt equity ratio and total assets to debt ratio, proprietary ratio. So the first one is debt equity ratio. So the debt to equity ratio is the relationship between debt and equity. Debt to equity. So, so the between the debt means here long-term debt and equity. Long-term debt and equity. Equity means owner's investment. Owner's investment is called equity. So long-term debt. So already we had taken the short-term debt in current ratio. So now it is long-term debt by shareholders fund. So one should clear about what is shareholders fund, and long-term debt is okay. You will know that it is more than 1 year. If any borrowings is for more than 1 year, then it is long-term debt. Debt by equity. So long-term debt includes long-term borrowings. So long-term provision, if any provision we made for longer period, that is long-term provisions, and long-term borrowings and long-term, so loan from bank, loan from, so the debentures, loan from public, deposits, all these are long-term debt. Then shareholders fund. Shareholders fund means owners investment. So in this we will consider the share capital. It is total investment made by the owner. And if any reserves and surplus, so whatever the profit earned by the organization will kept as a reserve to meet the unforeseen expenses in future, or for expected expenditure in the future, capital expenditure, or to repay the liability of the organization, or to buy the asset. Say replacement of asset we need fund. So the assets what we are using, that will not remain the same. So the life of that asset will become obsolete. So then you have to replace that one. For that we need funds. So for that the firm will retain some profit for future expenses. So we call it as a reserve. And surplus. So share capital includes both the equity, so shareholders equity and okay. In case of share capital, it includes equity shares and preferential shares. So the share capital means the equity and preferential both. So we are having two types of shares. One is equity, they are real owners, and preferential shares are having two priority. So we call them as a preference. One priority is in making a dividend, payment of dividend. Another priority is repayment of capital at the time of closure of the business. So they are not the real owners, but they are it's a secured liability for them. They are having some security against their investment. Where in case of real owners, equity shareholders are not having any security. If anything is remain, that will be the part of the equity shareholders. If nothing, then nothing they will realize. So that's why we call them as a preference shareholders. So we will include preferential shareholders and equity shareholders investment share capital. And if any reserves and surplus, then that will be added. In case of surplus, you may find profit and loss account balance. That is surplus. And indirectly, one can arrive. You see, if the information is not given directly, then one can arrive the shareholders fund indirectly. So what is that? Non-current asset, working capital. You have to add non-current assets and working capital. Then you have to subtract non-current liability. Non-current liability. So the liability say total you will take. From the total, you will subtract, excluding that long term. Non-current assets, non-working capital, you will add. Then you will subtract non-current liability. So non-current assets means other than current assets, whatever we had seen so far. Other than current assets means assets, fixed assets. So in fixed assets, we know that tangible, intangible asset. And if any long-term investments, non-current investment. And if any loans and advances given for longer period, the sum of that will become non-current assets. So non-current assets means tangible assets, intangible assets, that is the fixed assets, and non-current investments, the investment made for longer period, then long-term loans and advances, if any. You have to add all those, then you will get non-current asset. Then to this you have to add working capital. So what is working capital? So you know fixed capital. And working capital means, see, the current ratio is current assets by current liability. So if you subtract that, then you will get working capital. Current assets minus current liability. Current assets minus current liability. So then you will get working capital. So it is indirect method when the informations are not given directly. Then you have to find out. Then you have to find out shareholders fund by adding non-current assets and working capital. Then from that you have to subtract non-current liability. Then we will get shareholders fund. So the ideal ratio of this is also 2 is to 1. The ideal ratio of this is 2 is to 1. So then the financial position is good. If it is not, then it is worrisome. So then they have to make planning for reducing their liabilities. So here share capital, owners equity, then 12% debentures. It is liability, long-term liability, debt. Then provision for profit and loss account, positive balance of statement of profit and loss account. So this is profit and loss account balance. So there is a surplus. It is surplus, profit and loss account balance. So it's a owners equity. So you have to add this one to owner's equity. Then long-term loans itself, given that it is a long-term loan debt. Long-term loan debt. Then general reserve. General reserve is owner's equity. It's owner's equity. So the debt, long-term loans and 12% debentures. So debentures means nothing but it's a loan taken from the public. So whatever the amount we require, that will be distributed in smaller unit, divided into smaller unit and raised from the public. So against that, a document is given, that we call it as debenture. That proof of loan, the instrument what we call it as debenture. So debenture means nothing but a loan. So with the predefined interest rate and predefined repayment period, term of payment. Then equity share, what equity share, then equity share capital, general reserve, and balance of profit and loss account. So the sum of the debt is 12,50,000 and sum of owners in the investment, that is 12,50,000. So the ratio is 1 is to 1. 1 is to 1. So it is good. It is approved up to 1 is to 2. The assets are, so okay, 1 is to 2. The assets will be double the liabilities. So the financial position of the firm is not so good. So it is equal, not stronger, but it's okay. So when the assets are more than their debt, then the financial position of the firm is stronger. Okay, here share capital, owner's equity equity, then reserves and surplus, owner's equity, non-current investment, non-current investment is given, investment, that is non-current investment, then long-term loan is given. So only one long-term loan. Then debt is equal to only long-term loan, and owner's equity is share capital and reserves and surplus. So the ratio is 1 is to 2 only. 0.5 by 0.5 is to 1. So this is 1 is to 2. So the ratio is good. The firm's financial position is comfortable. Their financial position is sufficient for to meet their liabilities. The next one, find out the debt equity ratio from the following information: share capital, owner's equity, securities premium reserve, securities premium reserve. See, whenever you found reserve, treat it as a owner's equity, reserves, and negative balance of profit and loss account. So this is negative balance, so you have to subtract. So if it is positive balance, then you have to add, means loss, accumulated loss. So it should be subtracted. One should be careful about this. Then long-term borrowings, liability. Long-term borrowings is liability, non-current asset, current asset. So it's not relevant. So long-term borrowings only the debt and share capital, then securities premium reserve. Negative balance you have to subtract. See here, it should be subtracted. So the current asset, debt is 20 lakh 70,000 and owner's equity is 17 lakhs 25,000. So the financial position of the firm is not so good. The liability is more and our fund is less. So 1.2 is to 1. 1.2 is to 1. So another one. See, all these are very simple problems. Just you should familiar with the terms. Calculate the debt equity ratio from the following balance of a company. Total assets is given. See here, non-current liability is given, current liability is given. So you have to find out the equity. So what is that? See, one should, if you remember that liabilities plus capital is equal to asset. So the total asset is given. From total asset, if you subtract liability, then you will get capital. So that is owner's equity. That is owner's equity. So here total assets, current liability, non-current liabilities are given. Current liability, non-current liabilities are given. So from total assets, so equity from total assets, if you subtract non-current liability, then you will get the non-current liability and current liability. Then you will get the owner's fund. So that is total. See, this is liability. So assets minus liability is equal to capital. So we need that capital means owner's equity. So this here in liability you are not including that profit and loss account balance, reserves and all those things. Only liability you are considering. So the difference will be owner's equity. So here, so total assets minus current liability and non-current liability. So then you will get the owner's equity 8 lakhs. Then non-current liability is long-term loan. Current liability is current liability. So we know that short-term loans. So only we have to take only long-term. So that non-current liability is to be taken. So that non-current liability is debt. See, very simple question this one. So 12 lakhs divided by 8 lakhs, 1.5 is to 1. 1.5 is to 1. This one is also not 3 by 2. So the financial position of the firm is not So good. So this is about total debt equity ratio. Debt equity ratio. Now total assets by debt ratio. Total assets by debt ratio. So this reveals the relationship between the total assets of the firm and the long-term debt. So how much total assets we are having and how much liability we are having. So that ratio, that the relationship between these two variables. So the total assets to debit ratio, total assets by debts, total assets by debts. So total assets means non-current assets, tangible, intangible, non-current, investment, long-term, loans and advances, current assets. You have to include all current assets and cash, cash equivalent, short-term, advances and other assets. So the total of the asset side of the balance sheet. If any preliminary expenses and other things are given, then you have to subtract. Okay, it will not come normally. You will not see that one. If preliminary expenses are given, then you have to subtract that one. Or if any accumulated depreciation is given, then that should be subtract. So all these are expenses, but they had shown it as an asset on asset side. Then debt means long-term borrowings, long-term provisions. We had seen just now that one. So if the ratio is more higher, then that is positive. So more assets you are having, less liability. So you got that idea. So assets are more and your borrowings are less, debt is less, then the financial position is good, sound. If the debts are more or assets are less, then the financial position is weak. Higher the ratio between is the position of the business. Higher the ratio implies profitable profitable situation of the business concern. So it's financial sound. It's financially strong if the ratio is higher. Calculate the assets to debt ratio. Calculate the assets to debt ratio. So total assets by debt. So here shareholders funds. See, this is liabilities first. See, this is modern type of presenting that balance sheet vertical form. So we will present that one in T shape. So here it is presented in vertical form. So equity, liabilities, shareholders funds. See, this is shareholders funds. They had given clearly shareholders funds. So shareholders funds, in case of debt to equity ratio, you have to add these two. Non-current liability. Then this is current liability. So in case of current ratio, you will take current liability. Okay. Here the current, here also current assets. All these are current assets. You will take this one. Then this is assets, fixed assets. Now the total assets, fixed assets. Total assets you will take. You will take total assets 66 lakhs, 66 lakhs. So here calculation of total assets to debt ratio. Total assets by debt. So total assets, non-current asset, current assets. So it is same, the total, the asset side total. So just again he had shown that one by adding all the assets, tangible and fixed assets and intangible fixed assets, non-current assets, current investment, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, all those things added. So simply we had taken the total of assets. Then long-term borrowings, long-term provisions, excluding that non-current assets, non-current liability in case of debts. So long-term borrowings and long-term, here only the non-current liability we have to take these two, non-current liability. So in case of current ratio, we will take this one. So in owner's equity, uh, shareholders fund, that will be taken equity to debtors ratio. So we have to take the non-current liabilities, non-current liabilities. So if it is given in this way, it's very simple, easy. If we know the things. So debtors total assets comes to 66 lakhs and long-term debt is 27 lakhs. So 66 lakhs divided by 27 lakhs. So 2.4 is to 1. So the financial position of the firm is good. Assets are more than the debt. So nearly it is more than the double. So 1.5 times they are having more than the liability. So the financial position of the firm is good. So you are able to follow, I think. Yes. Total assets by long-term debt. Again the same. So here he had given shareholders capital, long-term loans and long-term loans, debentures, long-term loans and debentures, short-term loans, non-current asset, current assets. So non-current assets, current asset. By adding non-current asset and current assets, you will get total assets. Total assets. So total assets is equal to non-current asset, current assets. And long-term loans and debentures. By adding these two, you will get long-term debt. Long-term debt. This is short-term debt means, short-term loan means current liability. Current liability. This is non-current liability. This is current liability. We need non-current liability or long-term loans. So 6 lakhs plus 2 lakh 40,000. 6 lakhs plus 2 lakh 40,000. 8 lakh 40,000. This is non-current liability or long-term debt. So assets 12 lakh 60,000 by 8 lakh 40,000. 1.5 is to 1. So this also okay. Similarly, another one example. So by this, the debt to total assets to debt ratio will over. Equity to debts to equity ratio we had seen, and total assets to debt long-term debts ratio we had seen. So in this share capital, 9% debentures, this is long-term debt. Non-current investment, it's an asset. Building asset, inventories asset, trade payable, current liability not we have taken, trade receivable we have to take here. ఒక నిమిషం, trade receivables we have to take, general reserve should not take, balance of statement profit and loss is not, machinery, cash and cash equivalents, cash and cash equivalents. Okay, now total assets. So the total assets non-current investment, building, inventories, trade receivables, machinery, cash and cash equivalents comes to total assets 42 lakh 50,000, and long-term debt 9% of debentures and 15 lakhs. So total assets to debt ratio is 2.83 is to 1. So by this we completed total debt to equity ratio. Total debt to equity 17. Total debt to equity ratio. So by this we completed. Only in case of solvency, proprietary ratio is left. Okay, if you're having any doubt, you may ask. I will take the attendance meanwhile. Or you post in chat box.